All right, so this is just the intro to financial management, that first lecture that we would have face to face. Just going to be recording it this way so you guys can view it at your leisure. So for this first bit that we're going to go over, we're going to talk about the financial management decisions, what a financial manager will do, why they're doing that, what their goal is. We're going to look at the different ways we can organize businesses. And then we're going to talk about the conflict of interest between the managers and the owners of a company. So we normally talk about finance being in 4 key areas. So corporate finance, you'll also hear this referred to as business finance, investments, financial institutions, and international finance. This course, we are going to touch on each of those, but we're going to focus mostly on business finance for this course. And so when you think about what a manager does in finance, what we're trying to do is balance the company's assets and liabilities. You've already studied in accounting how the balance sheet has assets on one side and liabilities on the other, and we talk about short-term and long-term debt obligations and things like that. But in finance, we're focused on what exactly is the duration of the debt, what would the expected life be of our assets, are our cash flows fixed rate, or do we have a set in rate that we pay, or is this a variable or adjustable rate? And so the cash flows we receive and the cash flows we pay. And so in finance, we're really trying to balance all of those different issues. When we talk about investments, these are going to be working with stocks and bonds, but also things that derive value from that, derivative securities like options, forwards, futures, and swaps. We focus on the value of those investments themselves. We normally talk about risk versus return, and that when you take on additional risk, you expect to be rewarded for it, so you'll demand a higher return. So that's basically the view within investments. People that go into investments often are things like stockbrokers and financial advisors, but even like risk managers and people that analyze risk for firms would need to study that. Financial institutions are going to be companies that specialize in like creating financial products or buying and selling them. So people often jump right to banks. That's a really obvious one for us, but insurance companies also are financial institutions. They're offsetting people's risk, buying and selling risk. And so they're heavily involved, as well as the fact that they have such large investments because they have to plan for making eventual payouts. And brokerage firms as well, securities dealers will fall under that area. And then finally, international finance is one of those things where we focus on things like exchange rates, political risk, sovereign debt defaults. I actually have a paper I just published on terrorism activities, attacks against countries, and then the impact that has on U.S. markets for those types of firms. So there's a lot of international finance that occurs. As you can imagine, large sums of money are moving back and forth. And so there's a lot of people that go into this area. So those are the 4 major areas of finance. So those of you that are not thinking of a career in finance, you might think, well, why study finance? And if you're thinking about working in a different area, these types of decisions, like how to properly structure balance of payments, how to ensure that the money will be available at the time it's needed, how to ensure that all of your assets are working for you, no matter where you're working in a firm. Once you're at a management level, you normally end up needing, to go and answer those types of questions, right? And so financial managers, I'll actually go ahead and skip to an org chart to show you. So normally we talk about the chief financial officer a lot, because that's where we work. And if you notice that the responsibilities under the CFO normally get broken between the treasurer and the comptroller. And it's kind of looking, either trying to plan ahead to make sure the money will be there when we need it, or are we properly recording all of our transactions to ensure that all of our accounting records accurately reflect our business decisions. So, right. And I think I got my slide out of order. These are the types of questions, though, that a financial manager would answer. So, like, what type of long-term investments? How do we pay for these investments? Use debt or equity? So all of these types of questions. This is really how we're making a decision around our company, our firm, and its structure. Right. So I mentioned structure, right? And normally we talk about that as in debt to equity, but also like the organization of the firm. So let's talk about the ways we can organize. The three forms that we focus on in the U.S. are sole proprietorships, partnerships, and corporations. So sole proprietorships are going to be owned by a single person, and that's the easy one, but it's the one that has the highest level of liability. Partnerships are more than a single individual, and then you can structure that to reduce liability. And then corporations can be set up to limit your liability as an owner with some additional cost as well. So to start with a sole proprietorship, listing the advantages and disadvantages, really the biggest thing here is just that it's so easy to start. This is your default when you start doing some sort of business on the side. It is going to be a sole proprietorship. The problem, though, is you can't just sell this. You have unlimited liability, so anything would come back on you personally, and you can be sued. So it has some obvious disadvantages. So we will almost always recommend that someone try to structure their company or organize their company differently, such as a partnership. And so once you have a partnership set up, the company itself can go out and get more capital, or get capital easier than a sole proprietorship. Okay. Unfortunately, though, with a partnership, that's not a distinct legal person the way a corporation is. And so the liability is held within that partnership. When you get into like legal studies, there's normally what happens is you'll create a corporation, or you'll hire a corporation to be the general partner to worry about that level of risk. And then you can have limited partners that would be under that. So there's ways of structuring this, but it's sort of beyond the scope of this course. Just wanted to make sure you were aware that this structure existed. The last one we'll talk about is the corporation. A corporation is an entirely different person. And so once you've created that, the liability will stop with that corporation. However, it's a separate person, so that the corporation gets taxed, and then the proceeds that flow into you will be taxed at your level as well. So that's a disadvantage that comes with corporations. Normally in the United States, we'll just call it something incorporated. But when you're dealing with international finance, you'll see that there are other types of companies, have different names. Normally, it's just one of those things that that points out that it's not going to be a U.S. based firm, and so this is like one of those things that you can, when you're reading in the paper and stuff, it's just a signal oftentimes that it's somewhere else. But yeah, so let me now go ahead and move on to like what it is that we actually do. Like, why are we doing the things that we do? So when you think about what it is that corporations do, what are they supposed to do? Are they supposed to maximize profit? Or are they supposed to minimize the cost? Are they supposed to maximize market share? Are they supposed to maximize the current value per share for all of their existing stockholders, right? Are they trying to maximize the market value of the owner's equity, right? And it sounds like they're getting to the same thing, but they get there very differently, right? And so that's normally what we will say is that they're trying to maximize the owner's wealth. And they do that by maximizing the value of the firm. And they do that by taking on positive cash flow opportunities. However, it doesn't mean they should just do anything, right? Corporations are viewed as citizens. And so normally we want them to have what we call corporate responsibility. And so we want them to act in a manner that's above board and also helps build the communities in which they are. Enron there is listed for those that maybe haven't heard of this, or there's a story there. Enron was a company that was doing a lot of things that was hiding the true amount of debt that the firm had, and once that went under, it damaged across the markets, and it was an energy company. That's why it was Enron. It was for energy. It disrupted a lot of energy markets, particularly the California market. So because of that, we passed something known as Sarbanes-Oxley. And so what this did was it made it very difficult for firms to engage in that kind of aggressive positions in their accounting. But one of the downsides of this, one of the things that we saw was people saw that the costs that were associated with it, and they decided to just restructure themselves in a way that prevented them from needing to comply. So it didn't really fix the problem because those companies now just don't report at all. So there's still things that would need to be done, but that's just to show sort of the response and then the response to the response. Another thing that I want to make sure we touch on is the difference between the people that own an asset and the people that control an asset. And so we call this the agency problem. And so the principal is the owner of whatever it is, and then the agent acts on behalf of the principal, right? So if I'm a big actor, I'm the principal, and that's my acting talent, but then I'll have an agent that will go out and negotiate with studios for me to get work, and they'll be acting on my behalf, right? And so when we talk about this principal and agent relationship, it leads to something that we call the principal agent problem, and that's where you can have a conflict of interest, right? So here's some ways of talking about that within a company. So if you think about the way we compensate managers, we often will do so using stock options, and you'll hear that referred to a lot. They have these options. The reason we do that is so the manager is going to be financially rewarded by making the company worth more. And since the shareholders want their company to be worth more, it's in their interest to do that. Unfortunately, though, it can lead to some activity like taking very short-term actions because you just want to make sure your stock is good and you're not concerned far in the future. and that type of thing. Other things you can do is, obviously offer or threaten their jobs, that type of thing. But this is something that we struggle with, and in fact, I'm going to give you an assignment with a discussion board where you're going to look at a problem and then discuss the shareholder or the principal agent problem and flow there. So, and then next we're going to talk about the cash flows between the firms and the market. So we mentioned that, business finance is a thing, and that financial institutions are an important part of this thing going on as well. And then there's also investments, and those three pieces sort of go together. Businesses need funds. The financial institutions are the ones that make those funds available. And then the investments are how the money and the ownership stakes move back and forth. So, like for an example, well, this goes. I'll just give you this slide. You can pause it and just sort of read over this. But there's just to show sort of how these the firm is interacting with financial markets. It's interacting with the government. But these payments and cash flows going back and forth just sort of show how financial institutions, the markets themselves, and then business firms fit together. Okay, and so the last thing to talk about are those financial markets. We just went over those cash flows to the firm. Just want to talk about ways we talk about the markets as well. Primary versus secondary. Markets is a reference to, is the stock being sold for the first time, or the whatever the security is this the first time it's being sold, or is it being sold to other people? And so in primary, we refer to this as an initial public offering or an IPO. So this is the first time that it's ever available. So that's why it's the primary market. Once it's sold, it's no longer affiliated with, well, it's not affiliate, but no longer owned by the company, right? So the company has no say in anything. It's just a share that's out there, and people can buy and sell that ownership. And so that's the secondary market that handles that. So all your IPOs are primary, and things that we think of as the market, like the New York Stock Exchange, the NASDAQ, those are secondary markets where people are able to buy and sell. Dealer markets versus auction markets is just how it's structured. Are dealers maintaining a book, and then they're buying and selling to keep order flow? Or is it maybe an open outcry or some sort of other auction market that's going on? And then listed versus over the counter. Listed securities would be listed on an exchange like the New York Stock Exchange. Over the counter, these are often referred to as like penny stocks. They don't qualify to be on an exchange for whatever reason, or maybe they just don't want the level of oversight necessary for exchanges. So they don't have access to the wider markets, but they are out there with these small markets, and they're able to raise capital that way. So, and then that's really it. If you have any questions, please shoot me an email, and I look forward to seeing you guys in our class.